Hi everyone, and welcome to today's session, COVID-19 Managing Pension Costs. This session is one of a series of interactive webinars hosted by Phil Fisher's Employment, Pensions, Immigration and Compliance team, also known as EPIC. We'll be hosting a 30-minute session every Tuesday at 1 p.m, covering significant legal developments, hot topics, and offering practical advice for businesses and organizations in the ever-changing environment. My name is David Gallagher. I'm a partner in the firm and the head of the pensions department, and I'll be today's presenter and moderator. I'm delighted to introduce my co-host, Murray Keir, who is a senior associate in the pensions department and has been advising a number of clients on the issues that we'll be looking at today. Turning then to the first slide, which sets out the agenda. In today's session, we'll be covering the choices for employers to control their pension costs. We'll be looking specifically at some legal points around reducing pension contributions. We look at the furlough scheme and the effect that has on pensions for employees involved. And we'll look at the furlough scheme and the effect that might have on life assurance and some other issues that arise with life assurance. As many of you will know, life assurance is often regulated as if it were a pension scheme, particularly under HMRC guidance and tax legislation. Now, if you have any questions, please use the question box in your control panel on the right-hand side of the screen, and we'll aim to get through as many of them as possible. We've specifically left time at the end for questions. But if we don't get time to answer all the questions, then we will follow up individually with you. All of our sessions are recorded, and all of them are available on the Phil Fisher YouTube channel. So let's get started. Murray will take us through the first half of the webinar, and then I'll pick up on the second half. So over to you, Murray.
Thanks, David. So looking at the first of the slides, the choices for employers to control pension costs. Firstly, if the pension scheme you're using is for compliance with auto-enrollment, it may be possible to reduce the basis on which you pay pension contributions for your employees. Under auto-enrollment, there is a statutory minimum basis on which contributions must be paid, but it's also possible to pay contributions using other methods. In the next slide, I'll briefly set out the different methods for paying contributions. But if you're unsure about the method you use, you should check with your pension provider. Using a postponement period may allow you to reduce costs. The auto-enrollment legislation allows employers to use a postponement period of up to 3 months before enrolling any employee who becomes eligible for auto-enrollment. In the present circumstances, that period can be used for those employees who have yet to meet the eligibility criteria, perhaps because of their age or their level of salary. Or postponement can be used for new joiners. If you're not already using postponement, it may be an option to consider as it could produce a cost saving. Introducing a salary sacrifice arrangement for contributions will save both you and your employees national insurance contributions. Paying pension contributions using salary sacrifice is permitted by HM Revenue and Customs. Salary sacrifice works by the employer paying the employee's portion of pension contributions, and in return, the employee sacrifices part of their salary. As the employee is effectively being paid less, there is a saving on national insurance contributions for both you and the employee. But it's worth noting that salary sacrifice can't be used where it reduces earnings below the national minimum wage. If you're using more than one pension scheme for your employees, you will more than likely be incurring an additional expense that can be saved by consolidating all of the pension and administrative burdens into one pension scheme. If it is possible, streamlining the way in which pension contributions are paid for all employees will also save on payroll costs. So for example, that would be where you choose one method to pay contributions rather than having different methods for different employees. If you're using an external company to issue auto-enrolment correspondence to your employees, you may be able to make a cost saving by taking that function in-house. And the pensions regulator has produced template letters that you can use that allow you to do that. But bear in mind, there's an element of peace of mind that comes with paying an external provider to take care of the correspondence, as you know that it's being done in accordance with the law. Moving on to the next slide. I mentioned earlier that if you're basing pension contributions for auto-enrolment on more than the statutory minimum basis, you may be able to reduce that. The statutory minimum basis is to pay contributions in line with qualifying earnings. For the current tax year, that is earnings between £6,420 and £50,000. That means that contributions only have to be paid on earnings between those two figures. The overall minimum contribution must be at least 8% of that amount, with the employer's contribution being 3% and the employee paying 5%. The legislation, however, allows 3 other methods by which contributions can be paid. Number 1, basing contributions on basic salary. Where that is used, an overall 9% contribution must be paid, 4% of which must be the employer's contribution. Number 2, basing contributions on pensionable earnings for all workers being at least 85% of their total earnings. Where that is used, an overall 8% contribution must be paid, 3% of which must be the employer's contribution. And number 3, basing contributions on all earnings. Where that is used, an overall 7% contribution must be paid, 3% of which must be the employer's. If you're using one of the alternate methods for setting contributions, you could think about reducing that to the statutory minimum method. And moving on to the next slide. If you did decide to reduce contributions to the statutory minimum basis, or reduce contributions to a lower level than you're currently paying, that change would amount to what is known as a listed change under pensions legislation. Where a listed change is being proposed, there is a requirement for you to consult your affected employees. However, the requirement to consult only applies to employers with 50 or more employees. So bear in mind that it is the number of employees that you have, not the number of those affected by a proposed change. The majority of employers in the UK will have less than 50 employees and will not be caught by the requirement to consult on a change to reduce pension contributions. However, good practice dictates that if you're not caught by the requirement to consult, it may be best to follow some form of consultation if you are proposing a change to contributions. Doing so will ensure that you meet your duty of trust and confidence that you have to your staff. If a consultation is required, that consultation must last 60 days and be carried out with those affected employees and any representatives that they may have. The consultation gives you a chance to explain the reason for any change and also gives employees a chance to provide their input to the proposal. At the end of the 60 days, you should take account of the feedback received and then determine whether to proceed with the original proposal or amend it in some way. As a result of the current crisis, the pensions regulator has introduced a relaxation to the rules on the requirement to consult, stating that it will not apply the strict letter of the law where certain circumstances arise. There would be no need to carry out a consultation if the following 4 scenarios apply. Number 1, you have furloughed your staff who you are claiming for under the coronavirus job retention scheme. Number 2, you are proposing to reduce employer contributions for your money purchase scheme for furloughed staff only. Number 3, the reduced contribution rate for furloughed staff will only apply during the furloughed period. And number 4, you have written to your affected staff and their representatives to describe the intended change and the effects on the pension scheme and on your furloughed staff. If each of those 4 apply and a consultation is not carried out, the regulator will not take action against you. That relaxation previously only applied until the end of June this year, but it has recently been extended until the 30th of September this year. If you're contemplating a change which falls outside of the regulator's relaxation to the requirement to consult, you must continue to follow the legislation and consult with your staff if the change you are proposing requires you to. A statutory consultation is not the only legal issue here, as David will now go on to explain.
Thank you, Murray. So just turning then to the next slide. Once you have consulted, or you've decided that you don't have to, following the legislation that Murray's just gone through, or the regulator's easement, you still need to look at your pensions documents to see what needs changing. For most pension arrangements, you have legally binding documents in place with your pension provider, whether it's an insurance company or a master trust, etc. These will start with your initial contract with that provider, but they'll also usually be more recent documents. For instance, you often have annual contribution schedules, and these can be amended from time to time when there are pay rises, when there are substantial changes in the workforce. These will have to be amended to reflect any reduced contributions, even where you've gone through the process of agreeing that with your staff. If the reductions are temporary, then you might actually need to amend these documents twice, once at the start of the period of reduction, and then again at the end when full contributions are restored. Some of you will have an occupational pension scheme, and this is usually characterized by having trustees and a trust deed and rules in place. If so, you might need a formal deed of amendment to change the contribution rates if these are set out in the rules. And you'd need this deed of amendment even if the change is only going to be temporary, because otherwise the trustees are required to follow the rules that they've got in writing. Often a deed of amendment will require consent from the scheme trustees, and so you may need to factor that in to timetabling and the way in which you present and communicate your proposals. It would also make sense, if you have to go down this route, that you use the amendment process to give you some greater flexibility for future changes, so that you may be able to amend contributions without having to go through this process again. If your contribution rates are not set out in the rules, you do still normally have a statutory schedule, and this will also need amending, and normally in advance of any reduction taking place. A one-off amendment should be possible to the statutory schedule of contributions, even if it's for a temporary reduction. But for that, you would need still to be sure the date at which the contributions will go back up to the full level. Otherwise, you're going to have to amend at reduction and then amend again at going back up to the full level. And please, if you have a defined benefit or a final salary scheme, then we'd strongly encourage you to seek specific advice. These schemes have lots of complications, and these complications include statutory restrictions on the amendment process. A temporary suspension of employer contributions may be possible, and the pensions regulator has given some specific guidance about how to implement such reductions during the COVID crisis. But there are a number of employer-specific and scheme-specific factors that you would have to consider and that the trustees would have to consider. And to put it bluntly, one size does not fit all. One of the UK's responses to the COVID-19 pandemic is HM Revenue and Customs Furlough Scheme, or to give it its proper title, the Coronavirus Job Retention Scheme, CJRS. Now, if you want more information on the scheme itself, then please do see Phil Fisher's website, and you can look back at previous webinars. But for today, for the purposes of talking about pensions, let's just summarize the CJRS as a scheme in which employees don't work while they're on it. They usually have reduced salaries while they're on it, although the employer can top up. And there's a government grant supporting the employer's payroll costs. The grant covers minimum auto-enrollment contributions, but only the minimum. So Murray went through earlier how you can often be paying more than the statutory minimum. And while you're allowed to do that, you will only get CJRS cover for the absolute statutory minimum. And please be aware that the grant is reducing. From the 1st of August 2020, it will not cover employer pension contributions, even the minimum auto-enrollment ones. To cope with their reduced income, some employees might be tempted to opt out of their pension scheme to increase their take-home pay. They can do this, but if it's an auto-enrollment scheme, the legal way in which they do this has to be using a statutory opting out process. Now, the law on opting out makes it very clear that the employer cannot incentivize the employees to opt out. So please be careful about any communications around it and handing out opt-out forms. The staff themselves will also need to check when they'll be allowed to rejoin, and in some trust schemes, they might not be allowed to rejoin when they want. So they need to be careful of that. And they also need to accept the point that for a pension scheme, it is a savings vehicle, and you will get what you get out is based on what you put in. So if you do reduce your pension contributions or suspend them, that will eventually affect your income in retirement. As the furlough scheme changes in the next few months, we're going to see the introduction of part-time working and part-time furlough support. So this is going to become possible where the one employee could be part-time working for you and receiving salary, and part-time on furlough on the CJRS government scheme. In pension schemes, most schemes have carefully crafted rules to cope already with what you could call normal part-time workers. And this is so that they comply with overriding legislation that's been in place for over 20 years. For part-time furlough with part-time working, it may actually be easier on you as the employer and the pension scheme provider, and fairer on the relevant employees, for you to continue to treat them as full-time for pensions purposes, with the furlough and part-time income combined into a notional full-time salary. One point I just want to cover on certification for auto-enrollment. Each year, employers have to certify their pension scheme or schemes for auto-enrollment compliance. This is to confirm that the scheme meets certain minimum standards, including the value of the contributions paid. Where a change has been made to the pension scheme used for auto-enrollment, that does not affect the validity of a certificate you've already given, but you do have to take the change into account when next year you come to recertify the same scheme. It may even be that at the point you recertify, you choose to go back and undo any changes that were made due to the coronavirus. The key in all of this for you as employers is communication. You've got to be clear in your mind what you're doing. Once you are clear in your mind what you're doing, then you communicate that as best you can to the employees and leave scope for them to be able to ask questions of you. Finally, I'd like to turn to life insurance or life assurance. Tragically, as we know, COVID-19 can be a lethal disease. And for staff, all staff, it will cause concern, and particularly those with higher risks. And I'm sure many of you have had to deal with some difficult situations already. As any manager who's dealt with the death of a colleague will know, the availability of an insured lump sum can be a real comfort to the bereaved family. But in my experience in practice, it's a benefit that rarely gets a lot of attention at management level. And often it is just renewed as part of an annual renewal cycle of insurance for various different risks. It may be even that there's no specific senior manager with clear responsibility for renewing life insurance. Now, insurance policies are legally binding documents, and they have various terms that will need to be considered. The level of pay that's used for cover, the events that give rise to claims, and restrictions on cover or the level of cover in certain unusual circumstances. So looking at furlough, at this stage, it's important to be clear by looking at your existing policy, the specific one that you have with your insurer, to see if there may be any special treatment of staff that would capture people on furlough. For instance, some policies have special treatment for non-sickness absence. So that's something that you would need to specifically consider. You then need to look at your policy and how it will deal with reduced earnings. Some policies might provide that a temporary reduction of earnings is immediately reflected in a reduction in cover. For others, all you do is at your next annual return, you complete a schedule of employees and annual remuneration that is to be covered for insurance purposes. And sometimes that might coincide with the P60 process at the end of the tax year. You need to check at that point whether you have flexibility to put people back up to their pre-furlough earnings or to treat them as on the notional standard 100% salary, if that's what you want to do. And that certainly is normally possible with most insurer schemes. But you would have to specify that that was what you were doing, make it clear to the insurer, and be satisfied that they'd agreed to that. Turning to cover and whether insurers will cover deaths due to coronavirus, some insurance policies exclude disaster-type events or limit cover to lower levels, maybe 2 times instead of 4 times salary or something like that. Typically, the ones I've seen have been written by reference to one-off events such as terror attacks or transport disasters. But depending on the way in which the insurer has phrased that term, a contagious disease is certainly possible for being included in that carve-out. And if it isn't carved out in your 2020 policy, you can be quite confident there will be very specific wording for it in your 2021 policy. So in years to come, we must expect to see limits or exclusions by some or all insurers. And it will be at that point that you would really need to look at the competitive market to see if there are differences in cover that is being provided. Looking back at cases that you might have now, in deciding whether or not the current disaster wording would capture death due to coronavirus, there may also be issues in practice with whether a death has been certified by the doctor as being COVID related or not. Insurance policies are often written in the expectation that there's only ever one cause of death and that this exclusion would be triggered by a number of claims with the same cause of death. But actually, in practice, death certificates often number a series of different medical conditions. That is largely what we were wanting to say in terms of our presentation on the slides that we've prepared. It's now an opportunity for you to ask questions. A reminder, that's in the box on the right-hand side in your software for the webinar. There's a couple of questions there that we're going to turn to now, but there is still a couple of minutes left. So if you're quick at typing, you might still get a question in if you've got one pressing. But just to turn to the ones we have got, Murray, if you don't mind, I'd like to throw this first one to you. And this is, if we have staff on reduced pay for reduced hours, they're getting paid less, so they're putting less into their pension, both as employee contributions and employer contributions. Do we have to consult about that?
Thanks, David. Not normally. I would say that because pension contributions are usually a percentage of pay each month and not a set amount of cash each month, it would only be if you reduce the percentage rate of contributions that you would normally have to consult. And as I mentioned before, it's worth pointing out again, that the obligation to consult on a pension scheme change only applies where you have 50 or more employees.
Thanks, Murray. Second question, which I think I'll take for myself. If stock markets are low, and I think we all agree they probably are at the moment, is it actually good for employees to keep up their pension contributions? Yeah, okay. So, well, that's a good question. And it is important to remember that pensions are very long-term investments. An employee who's currently in their early 20s, it might be 45 years before they start to draw on their pension. So there's many years of investment return there. But as lawyers, what we have to point out is this is actually a difficult area for employers to be commenting on. Financial services law controls who can give financial advice, and what you should normally expect to do is to refer employees to authorized advisors or to provide them with literature which has been prepared by your pensions provider, who themselves will be regulated for financial services. Because as an employer, you can pass on information, but you can't give anything that could be construed as advice. And this is actually a topic that we will be looking at more closely in another pensions webinar that we've got later in the EPIC series. So seeing that we're getting close now to 1:30, if you don't mind, what I'd like to do is close on the questions there and just thank everyone for joining today's session on managing pension costs. People from near and far. I recognize one name for someone who's in Japan, so very grateful to have someone that far away tuning in. We hope you all found it useful. As mentioned, all of our sessions are recorded and can be found on the Phil Fisher YouTube channel. If your questions weren't answered, our team will follow up individually with you. Or if there's a topic that you'd like to discuss further, then please email either us at david.gallagher@fieldfisher.com or murray.keir, K-E-I-R, @fieldfisher.com. So please, everybody, keep safe, and we hope that you can join us next week and in weeks to come. Next week, our session is on cyberbullying, what to do when harassment goes online. Thank you.